Welcome to vTalkInsight, Risk Sentiment Daily for January 19th, 2026. Global equities are still riding a powerful, broad-based advance, but policy and geopolitical fault lines are getting sharper, so the balance between chasing carry and protecting capital is more delicate than it has been all year. Let us unpack how that late-cycle mix is shaping risk appetite across equities, credit, and commodities right now. Across markets, the dominant tone remains late-cycle constructive rather than outright cautious. Equities globally are still supported by strong breadth, with multiple regions and size segments participating, while volatility gauges for equities, rates, and foreign exchange sit in the mid-teens or lower, well below stress levels. At the same time, the S&P 500 has stalled with only marginal day-to-day moves, which fits a market that is largely priced for good news and is now more sensitive to surprises. The constructive core rests on three pillars. First, market breadth looks unusually healthy, with small caps, mid caps, equal weighted indices, and non-US markets outperforming or keeping pace, a clear contrast to earlier periods when only a handful of mega-cap technology names carried the tape. Second, growth and earnings data are coming in stronger than expected, with high productivity, falling unit labor costs, and forecasts for solid gross domestic product and double-digit corporate profit growth. Third, an intense AI-driven investment cycle is boosting confidence in future revenues across semiconductors, cloud platforms, infrastructure, and even capital markets activity. Balancing that, late-cycle warning signs are getting louder. Central bank officials are signaling little urgency to cut rates. Long-term yields have pushed higher and curves are flattening, while legal and political pressure around the Federal Reserve and credit markets is increasing the policy risk premium. Geopolitical tensions from Iran to East Asia, tight credit spreads reminiscent of 2007, and mounting concerns over energy and power costs linked to data centers are encouraging investors to add hedges in gold, oil, and alternatives rather than simply adding gross exposure. So the overall read today is a broadly risk-on environment, but with more deliberate risk management and a clear recognition that the cycle is mature. A key bullish driver is the broadening global equity rally. Advanced decline measures on major indices are printing at or near all-time highs, and virtually all tracked country benchmarks are trading above their 200-day moving averages, which points to a synchronized upswing rather than a narrow, momentum-driven spike. Within the U.S., small caps, mid caps, and equal-weighted indices have notched long winning streaks and, in several cases, record highs, while the traditional cap-weighted S&P 500 is now being joined by utilities, software, and infrastructure names in leading the move. This broadening is also visible in style and sector rotation. Small-cap benchmarks such as the Russell 2000 have outperformed large caps for 10 or more consecutive sessions, supported by better earnings guidance and more optimistic commentary from management teams. Mid-cap indices and equal-weighted baskets are outpacing the mega-cap heavy benchmarks, and outside the U.S., Asian markets like Taiwan and Korea are setting new highs as technology strength spills over into regional financials and industrials. For portfolios, this pattern reduces concentration risk and opens up a wider opportunity set across cyclicals, value, and international exposures. However, some analysts expect the unusually wide participation seen early in the year to narrow again, with big tech potentially regaining leadership as growth and AI narratives reassert themselves. That means the sustainability of small-cap earnings upgrades and the persistence of breadth indicators will be important barometers of whether this broad-based bull leg can extend or whether leadership reconcentrates in a handful of names. Underpinning the equity advance is resilient growth and earnings momentum. Recent U.S. data include an Atlanta Fed gross domestic product tracker above 5%, forecasts for full-year growth around 2.75%, and a notable pickup in productivity of roughly 4.9% alongside a near 2% drop in unit labor costs. That combination of solid output and easing cost pressures point to a favorable growth inflation mix that helps justify equity risk premia despite sticky consumer price readings. On the corporate side, earnings are expected to do the heavy lifting. Consensus views for the S&P 500 call for 10 to 12% gains driven primarily by profit growth rather than multiple expansion, with companies emphasizing margin preservation to amplify bottom-line outcomes even in politically sensitive sectors like financials. Small caps are seeing even stronger revisions, with forward-looking earnings estimates rising markedly faster than for large caps, which supports the idea of a more durable rotation into smaller and more cyclically exposed names. That said, the benefits of this macro and earnings backdrop are uneven. The lower half of the U.S. economy still faces pressure. Some hardware and energy-exposed technology names are dealing with rising input and electricity costs, and certain banks are wrestling with regulatory uncertainty around consumer credit. Upcoming earnings seasons, starting with high-profile technology and consumer names, will therefore be critical tests of whether the underlying profit engine can keep pace with elevated expectations, or whether markets need to recalibrate valuation assumptions. The third major supportive force is the AI-driven capex and earnings boom. Flagship semiconductor manufacturers have reported strong results and announced capital spending increases on the order of 15 to 20% year over year, with total investment plans in the tens of billions of dollars backed by long-term commitments from clients, such as major graphics and smartphone leaders. At the same time, hyperscaler capital expenditure growth expectations for the year have been revised up from around 30 to roughly 34%, with room for upside as demand for AI infrastructure keeps exceeding earlier forecasts. This investment wave is broadening the AI value chain. AI-related equity valuations are increasingly seen as grounded in strong earnings growth rather than pure speculation, and small-cap technology companies are expected to benefit disproportionately as spending spreads beyond the largest platforms. Record corporate bond issuance linked to AI and utilities, new data center projects like large-scale expansions in Texas, and a significant U.S.-Taiwan trade pact directing at least $250 billion into chips, energy, and AI sectors all point to a multi-year infrastructure build-out. The boom does come with constraints. Surging electricity demand from data centers is now a primary driver of wholesale power prices in some grids, raising questions about long-term margins for power-hungry AI players and prompting policymakers to redesign auction and pricing mechanisms. Uncertainty also remains over whether enterprise demand will fully justify the capacity being built, and there is talk of a rotation from the most crowded AI trades toward companies with strong sales growth but more modest valuations. Upcoming events, including high-profile initial public offerings in the AI space and new rounds of AI-linked debt issuance, will be important sentiment markers for this theme. On the risk side, higher-for-longer rates and policy uncertainty are front and center. Multiple Federal Reserve officials have signaled there is no current justification for rate cuts, with some commentary suggesting that policy is close to neutral and appropriate, and that rates could remain on hold well into 2026 absent a clearer disinflation trend. Market pricing for near-term U.S. cuts has faded, front-end yields have edged higher, and the yield curve has flattened as 2 to 10-year spreads narrow, while long bonds hover at elevated levels. Longer-dated yields have also faced upward pressure from shifting expectations around growth, fiscal policy, and central bank leadership. Talk of a more hawkish candidate for Fed chair, along with concerns about threats to Federal Reserve independence and upcoming Supreme Court rulings on tariffs and Fed authority, are adding a governance premium to U.S. assets. This backdrop complicates duration as a hedge, because any surprise on policy or inflation can move long and yield sharply and ripple through equity valuations and credit funding costs. Policy divergence abroad adds another layer. The Bank of Japan is expected to move very cautiously on rate hikes despite currency intervention risks, while debates over housing affordability, government-sponsored mortgage purchases, and even stablecoin regulation in the U.S. highlight how credit and liquidity tools are becoming politicized. For markets, the key issue is that policy errors now risk either reigniting inflation through overly aggressive easing or tightening financial conditions abruptly through missteps on regulation or central bank governance, either of which could destabilize today's relatively calm rate and foreign exchange environment. Geopolitical and energy market tensions form the second major headwind. U.S. military actions and sanctions toward Iran, accompanied by the redeployment of naval assets to the region, have raised the risk that up to 1.5 million barrels per day of Iranian exports could be disrupted. While global oil supply is currently described as ample relative to demand, any escalation could quickly push up Brent prices and spill over into broader inflation expectations and consumer sentiment. Energy stress is not limited to crude markets. In North America, surging electricity demand from AI data centers is now the dominant driver of wholesale power prices in some grids, with policymakers considering emergency auctions and 15-year contracts to secure supply. There is mounting political pressure to shield households from rising bills, proposals to create separate pricing tracks for data centers, and growing regulatory scrutiny over how quickly new capacity is approved, particularly in states like Texas and regions such as the PJM grid. This environment creates both beneficiaries and losers. Utilities and grid equipment providers could see more predictable long-term demand, while some legacy energy producers face headwinds from oversupply and competition from new entrants, such as Venezuela returning to the market. Technology companies reliant on cheap power may experience margin pressure and political backlash, and investors are increasingly using commodities and gold as hedges against both geopolitical upside risk in energy prices and the broader policy uncertainty tied to energy affordability. The third key risk driver is rising credit and valuation complacency. Corporate bond spreads across investment grade and high yield are at their tightest levels since 2007, and global credit spreads more broadly have compressed to multi-decade lows, even as parts of the U.S. economy remain fragile. Some large asset managers are warning that investors may not be adequately compensated for late-cycle default and liquidity risks, particularly in lower-quality credits and in segments exposed to weaker households. Structural shifts add to that concern. There is growing evidence that credit risk is migrating from regulated banks to private funds and shadow banking structures, where underwriting standards can be looser and transparency lower, raising the risk of hidden vulnerabilities if the cycle turns. At the same time, heavy issuance from megacap technology and AI-related borrowers is distorting some benchmarks, with select corporates now funding at levels tighter than sovereigns like France, which concentrates risk for index-based investors. To be fair, strong corporate balance sheets and attractive all-in yields mean fixed income still offers appealing carry, and demand for bonds remains solid as some investors question stretched equity valuations. But when tight spreads coincide with talk of asset bubble-like behavior, populist proposals such as capping credit card rates and ongoing fiscal expansion, the system becomes more sensitive to shocks. Any unexpected default cluster, regulatory surprise, or sharp move higher in yields could trigger an outsized repricing, making careful credit selection and valuation discipline increasingly important in the months ahead. Stepping back, today's picture is of a market that still leans risk-on, powered by a broadening equity rally, resilient growth and earnings, and an AI-driven investment cycle, but with clear recognition that policy, geopolitical, and credit risks are building under the surface. How these forces resolve will depend on whether earnings continue to validate high expectations, whether central banks can navigate higher-for-longer settings without policy missteps, and whether geopolitical and energy tensions remain contained enough to avoid destabilizing inflation or growth. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.